Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show, the Perspectives broadcast. My name is Jeff Bernier. I'm happy you decided to spend a few minutes with me today. Well, my George Bailey finished well. You know, George Bailey was the main character in the movie It's a Wonderful Life. I'm sure you're all familiar with it. And the central lesson for George was the realization of his own profound value and the positive impact he had on his family, his friends, and his entire community. After seeing a vision of what his world would look like had he never been born, where Bedford Falls is a much darker place and the people he loves are worse off, George understands that his sacrifices and everyday acts of kindness have deeply touched many, many lives. He learns that life's worth is not measured by wealth or personal achievements, but by the relationships we build and the good we do for others. George discovers that even when he feels disappointed or his life is disappointing or burdensome, every individual's existence has purpose and meaning, and that community, love, and selflessness are what truly makes a life. In my book, The Money and Meaning Journey, I describe my father, Walt Bernier, as my hometown's George Bailey. He served the people of Pelham, Georgia at Pelham Banking Company for 47 years, 33 of those as the president. He loved the people of his town and loved being their community banker. Well, he passed away a few weeks ago at the age of 94. He lived a long and meaningful life. But my dad also planned really well. While his health deteriorated in the last year or so, he never had to worry if he had enough to cover any health or financial needs that could arise. While I walked alongside many clients in the estate administration process over the years, this is the first time I've done it as an executor. I've learned a few lessons about the challenges and emotions of saying goodbye to my dad and mentor while also handling necessary administration. Those are lessons we might discuss at a later show. What I want to spend a few minutes on today, though, is how we might need to adapt our planning to longer lives, like my dad, and to new risk. As people live longer and the retirement landscape shifts, it's more important than ever to consider our approach. So let's get started. Let's start with the big picture. Thanks to advances in healthcare, nutrition, and technology, life expectancy is on the rise. In fact, projections show that by 2060, the average American could live well into their mid-80s, and the number of centenarians, those living 100 to 100 and beyond, is expected to quadruple by 2054. That's an incredible achievement, but it also imposes new challenges for retirement planning. Traditional retirement was seen as a 15 or 20-year period after leaving the workforce. Now people could spend 25, 30, or even 40 years in retirement. This shift means that old assumptions for saving, investing, and spending in retirement may no longer be sufficient. So what are the new risks that we need to consider? The first one is probably the one we're most aware of, and that's outliving our savings. The biggest concern is longevity risk, the possibility of outliving your money. Research shows that by extending retirement by just 5 years raises the risk of running out of money by 41%. Number two, healthcare cost. Rising healthcare expenses are among another major factor. That's why health savings accounts, or HSAs, are becoming a crucial tool for managing these costs, especially as premiums and out-of-pocket expenses continue to climb. Number three, inflation and market volatility. Inflation erodes purchasing power, and markets up and downs can impact the value of retirement portfolios, making it harder to plan with confidence. This market volatility also causes many investors to make investment choices that can cause significant damage to long-term security. Next is retirement timelines, changing retirement timelines. You know, many people plan on delaying retirement due to financial considerations, but others are forced to retire early because of health issues or caregiving responsibilities. Government involvement. The latest 2025 Social Security Trustees Report revealed that Social Security's trust fund is projected to be depleted by 2033. At that point, the program will no longer be able to pay full benefits, leading to an estimated 19% across-the-board benefit cut for all beneficiaries, regardless of age, income, or need, if reforms aren't enacted. Another challenge is higher taxes. As of June 2025, the total federal government debt of the United States is approximately $36 trillion. This equates to $106,000 per person, or roughly $274,000 per household. Now, many believe this isn't a problem, as some of this debt is actually owed to our own citizens in the form of government bonds. Regardless, the amount of resources required to pay interest on the debt is staggering. Finally, slower growth and lower returns. Due to the amount of capital that must be extracted from the private sector to service this government debt, economic growth may be anemic, and therefore returns to investors could be lower. Although there's not definitive evidence that he said it, the quote, "Find work you love and you'll never work a day in your life," is commonly attributed to Confucius, the ancient Chinese philosopher. Given the risk I just identified, the traditional idea of retirement may be questioned. Some experts suggest that full retirement at age 60 or 65 may not be practicable for those who live into their mid-90s or beyond. My dad actually worked to age 71, not out of necessity, but because he found meaning and enjoyed his work. We are seeing more people working part-time or pursuing encore careers. We see more people engaging in lifelong learning and career changing into more passionate work. We see more people choosing a phased retirement or more flexible work arrangements so they can extend their working years. And then finally, many are exploring non-traditional retirement lifestyles like community living or volunteering. Whether by necessity or choice, traditional retirement is increasingly viewed not as an endpoint, but as a new beginning, a chance to stay active, engaged, and purposeful. So, what is the financial professionals or the financial planning industry? How are they responding to these challenges? Well, there's a few things that the industry at large is doing. The first one is there's more personalized longevity planning. Advances in predictive health data, like new blood tests and comprehensive body scans, are giving individuals more accurate insights into their likely health span, not just lifespan. This can help tailor financial plans to individual needs. Digital tools and better modeling. Technology is making it easier to manage investments, to track spending, and to plan for healthcare costs. There are opportunities to more fully diversify portfolios to address the deep risk as identified by the author and financial advisor William Bernstein. Bernstein specifically names 4 main sources of what he calls deep risk, sometimes called the 4 horsemen of financial disaster, similar to some of the themes I talked about before, but let me hit these. Number 1, inflation. High inflation, again, can erode the real value investments, particularly bonds and cash over long periods of time. Number 2, deflation. Persistent deflation can lead to falling prices and economic stagnation, harming both asset values and economic growth. Confiscation. This includes government actions, such as heavy taxation, expropriating assets, or outright seizure of property. And then finally, devastation. This refers to catastrophic events such as war, revolution, or major geographical upheavals that can destroy wealth and disrupt economic systems. So you can think about shallow risk as being normal economic volatility, but these 4 deep risks are the things that we have to be most concerned about over long periods of time. So the tonic or the prescription to defend against these deep risks means broader diversification. So broader diversification, and consider owning asset classes that can help, specifically stocks, international diversification, treasury-inflated securities, and broader sources of risk and return like infrastructure, reinsurance, and private market investments. All in the context of your need, ability, and tolerance for risk. So the industry has brought more opportunities to, and some of it because of technology and lower cost, to more fully diversify portfolios to defend against these and the other risks we've talked about. Another way the industry is addressing these concerns is technology. I mean, the technology revolution has made it easier to invest in lower cost solutions. Now, one caveat to this, however, is that due to low cost, some investors actually overtrade or speculate more, which I believe is a huge mistake. So while the technology revolution has made costs lower, it can also encourage inappropriate investor behavior. Also, we now have automatic enrollment and Roth options in our retirement plans. More employers are auto-enrolling workers into retirement plans and expanding Roth 401k options, helping employees save more and diversify their tax strategies. So that's a lot of information. But what can we do now? What can we do to prepare for this new era of retirement, in addition to some of the ideas that I've already talked about? The first one is obvious, and that's start planning earlier. The sooner you begin, the more flexibility and security you're likely to have. Now, this one's going to sound a little bit self-serving, but you can work with an advisor. According to a recent study, those who plan for longevity and work with an advisor feel more confident about their retirement prospects. Boost health savings. Take advantage of HSAs and other vehicles to prepare for healthcare expenses. Embrace flexibility. Be open to adjusting your retirement age, your lifestyle, and your spending as circumstances change. You should have not only a plan A, your ideal plan, but you should have a plan B and a plan C. And that's really the value an advisor can bring, is that it's not really about creating a plan. It's about monitoring and adjusting a plan in real time as your circumstances and the markets change. And then finally, as I already mentioned, hold a broadly diversified portfolio. And remember that investor behavior could have more impact on providing a long-term sustainable income than actually the investments themselves. Let me say that again. Investor behavior can have more impact on providing a long-term sustainable income than the investments themselves. So, the landscape of retirement is changing rapidly, but with the right strategies and mindset, you can turn longer lives into an opportunity rather than a challenge. We are a blessed nation. We are a blessed people. I believe that most people with some education and training can earn reasonable compensation by creating value for others, and with enough time and discipline, can achieve some measure of financial security. And like my dad, you can feel like you finished well. Thanks for listening. Hope you found this helpful. If you have any questions or would like to discuss anything I discussed today, please reach out. You can email me at moneyandmeaning@tandemgrowth.com. I'd encourage you to check out past episodes of the Money and Meaning Show on iTunes, Spotify, YouTube, or other streaming services. And of course, give me your feedback. And of course, I'd love it if you would share the show. I appreciate it so much. Until next time, have a great day.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted, and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.